The signal the data arrived quietly on a Thursday in late December 2025, buried in a routine. Treasury Department publication was a number that deserved far more attention than it received. China's holdings of American government debt had dropped to $688.7 billion, a figure not seen since the global financial crisis 17 years earlier. Most financial journalists glanced at the report and moved on to other stories. Few mentioned it as minor news about foreign investment patterns. Almost nobody connected it to the larger pattern unfolding over the previous decade. The business network spent more time discussing quarterly earnings from technology companies than examining what might be the most consequential financial shift of our lifetime since reaching a peak above $1.3 trillion in late 2013. China has been steadily walking away from American debt. The reduction now exceeds $600 billion. In March 2025, China slipped to third place among foreign treasury holders, falling behind both Japan and the United Kingdom for the first time in nearly a decade. The trajectory has been remarkably consistent, regardless of which party controlled the White House or which faction dominated Beijing's economic planning. This is not the behavior of an investor making routine portfolio adjustments. This is the behavior of a nation preparing for a fundamental shift in the global financial order. History offers a precise parallel for what we are witnessing. In the summer of 1931, France began requesting that Britain convert its pound sterling holdings into physical gold. The request was perfectly legal under the monetary system of that time. France simply wanted to hold gold instead of British currency. Britain had been the financial center of the world for generations. The pound sterling had dominated international trade since the Napoleonic Wars. British officials assured everyone that meeting France's request would pose no difficulty whatsoever. Within 2 months, everything collapsed. Britain could not produce enough gold to satisfy the conversions. On September 21, 1931, the government suspended gold payments entirely. The pound immediately lost nearly a third of its value against other major currencies. The financial supremacy that Britain had maintained for 2 centuries began its terminal decline. France had exposed a fundamental weakness in British finances by simply asking Britain to prove it could pay its obligations. China appears to be conducting a similar examination of American financial strength, and the results will determine whether the dollar survives as the world's reserve currency. How reserve currencies die. The global financial system operates on a foundation that most people never think about. When a currency achieves reserve status, other nations hold it in their central banks as a store of value. They use it to settle international trade. They trust that it will maintain its purchasing power over time. This arrangement seems natural and permanent to those who live within it. But history shows that reserve currencies rise and fall like empires themselves. This trust creates a peculiar trap for the nation issuing the reserve currency. To supply the world with enough of your currency to facilitate global commerce, you must run persistent deficits. You must borrow and spend more than you collect in taxes. The more successful your currency becomes internationally, the more debt you must accumulate domestically. Economists call this the Trifon dilemma, named after the Belgian economist who identified this inherent contradiction in the 1960s. Britain learned this lesson in the most painful way possible. After the First World War, the British government owed enormous sums to creditors, both foreign and domestic. The cost of that conflict had drained the treasury, while everyone celebrated victory parades and territorial expansion. By 1931, servicing existing debts consumed 44% of all government revenue. Nearly half of every tax pound collected went straight to paying interest on old obligations. France had recovered economically from the war faster than most observers expected. French bankers watched British finances deteriorate throughout the 1920s while London maintained an appearance of strength and stability. They calculated that Britain held approximately £150 million in gold reserves, while foreign creditors held £400 million in sterling deposits at British banks. The arithmetic was devastating. If even a fraction of those foreign creditors demanded conversion to gold simultaneously, Britain would be completely drained. France decided to test this vulnerability methodically rather than all at once. Starting in July 1931, French officials began requesting gold conversions in increasing amounts. Gold bars were physically loaded onto ships and transported from London to Paris. Within weeks, the Bank of England had lost over £50 million in reserves. By September, the situation had become untenable. Britain announced it would no longer convert pounds to gold at the fixed rate. The empire that had dominated global finance for 200 years had just admitted it could not honor its fundamental monetary commitments. The American debt trap the United States today faces a financial position that would have seemed unimaginable just 2 decades ago. The national debt has reached $38 trillion. The number is so large it becomes abstract, difficult to comprehend in any meaningful way. To put it in perspective, if you stacked 38 trillion $1 bills, the pile would stretch past the moon and continue deep into outer space. A more useful measure is the debt-to-GDP ratio, which compares what a nation owes to what it produces economically each year. For the United States at the end of fiscal year 2025, that ratio stands at roughly 122%. This means America owes more than its entire annual economic output. Britain in 1931 had a lower ratio when its financial system collapsed. The United States has now entered territory that historically precedes severe monetary crises. But the truly alarming figure is the cost of servicing this debt. In fiscal year 2025, federal government spent $970 billion just on interest payments. That represents almost a tripling from $345 billion in 2020. Interest costs have exploded in just 5 years. This acceleration reflects both the growing principal and the higher interest rates that followed the Federal Reserve's inflation-fighting campaign. For the first time in American history, the government now spends more on debt interest than on national defense. The Congressional Budget Office projects that interest payments will exceed $1 trillion annually beginning in 2026. By 2035, the projection reaches $1.8 trillion in annual interest alone. This creates an impossible situation for the Federal Reserve. Raising interest rates to combat inflation automatically increases the government's borrowing costs. Every half percentage point increase in rates adds approximately $100 billion to annual interest expenses. But cutting rates risks reigniting inflation and undermining confidence in the dollar. The Fed finds itself trapped between mathematical impossibilities. Much like the Bank of England in 1931, they cannot raise rates without exploding the deficit further. They cannot cut rates without destabilizing the currency. They cannot maintain the current path without eventually exhausting the willingness of foreign creditors to keep financing American consumption. China appears to have recognized this trap with perfect clarity, which explains why they have been reducing their exposure to American debt systematically for over a decade. China's systematic exit the pattern becomes unmistakable when you examine the data across time. China held a peak of $1.317 trillion in United States Treasury securities in November 2013 that represented the high water, a mark of Chinese confidence in American debt instruments. At that moment, holding American government debt seemed like the safest possible investment for a nation accumulating massive trade surpluses. Since that peak, China has reduced its holdings by more than $600 billion. The decline has not been erratic or reactive to short-term market conditions. It has been methodical, deliberate, and sustained across multiple political administrations in both countries. Neither the trade war under Trump nor the attempted reset under Biden altered the trajectory. The selling continued regardless of diplomatic rhetoric or tariff negotiations. By October 2025, Chinese holdings had fallen to $688.7 billion. This represents the lowest level since the global financial crisis of 2008, but the raw dollar amount understates the strategic significance of what has occurred. In March 2025, China dropped from second place to third place among foreign holders of American debt. Japan now holds the largest foreign position, followed by the United Kingdom. China, which once dominated foreign treasury holdings, has systematically reduced its exposure while other nations maintained or increased theirs. The timing of these reductions reveals careful planning rather than panic selling. Large sales tend to occur during periods of dollar strength, when China can obtain maximum value for each security sold. Purchases of alternative assets follow predictable patterns tied to commodity price cycles and geopolitical developments. Beijing's financial strategists appear to be executing a multi-decade plan with discipline that Western observers often fail to appreciate. This is not a fire sale. This is an orderly unwinding of a position that Chinese strategists have apparently concluded carries unacceptable risk. They watched what happened to Russian foreign exchange reserves in 2022. When Western nations froze approximately $300 billion in Russian central bank assets following the invasion of Ukraine, that freezing demonstrated something that financial textbooks rarely discuss openly. Reserve assets held in foreign jurisdictions exist at the pleasure of the nations hosting those assets. They can be immobilized or seized if geopolitical circumstances change dramatically enough. China appears to have drawn conclusions from that lesson and is acting accordingly. The gold accumulation while reducing its exposure to American debt, China has been accumulating gold at a pace not seen in decades. The People's Bank of China reported 13 consecutive months of gold purchases through late 2024, adding substantially to reserves that already ranked among the largest in the world. This buying spree continued even as gold prices climbed to record highs, suggesting that price sensitivity has been subordinated to strategic necessity. Official Chinese gold reserves now exceed 2,300 tons. That figure almost certainly understates the true amount, since China has historically disclosed reserve increases only after accumulating for extended periods without announcement. The actual holdings could be significantly higher. Some analysts estimate that unreported purchases through state-owned banks and sovereign wealth funds could double the official figure. The strategic logic is straightforward. Gold cannot be frozen by foreign governments, cannot be seized through sanctions or blocked from international payment systems. It sits in vaults on Chinese territory under Chinese control, immune to the kinds of financial warfare that immobilized Russian assets. Central banks globally have been accumulating gold at the fastest rate since the 1960s, but China and Russia lead this trend, with purchases that dwarf those of other nations. They are not buying gold as a speculative investment. They are buying it as insurance against a monetary system they no longer fully trust. Gold prices have responded accordingly. The metal has surpassed $4,000 per ounce, reaching levels that seemed implausible just a few years earlier. This price movement reflects not merely investor sentiment, but sovereign demand from nations, actively preparing for potential disruption of the dollar-based financial order. The accumulation serves multiple purposes simultaneously. It provides a hedge against dollar depreciation. It offers a sanctions-resistant store of value. It creates optionality for future monetary arrangements that might require hard asset backing. And it signals to other nations that alternatives to dollar dependence are being constructed. Each ton of gold that enters Chinese vaults represents a ton of confidence withdrawn from the American financial system. The message is not subtle, and it is being received clearly by financial observers worldwide. The alternative systems China is not merely selling American debt and buying gold. It is actively constructing the infrastructure for a parallel financial system that could eventually operate independently of the dollar. This is not speculation or conspiracy theory. It's documented policy being implemented in plain sight. The most significant development is mBridge, a cross-border payment platform built on distributed ledger technology. The project connects the central banks of China, Thailand, the United Arab Emirates, Saudi Arabia, and Hong Kong. It allows participating nations to settle international transactions directly in their own currencies without routing payments through American correspondent banks or the SWIFT messaging system. mBridge completed its minimum viable product phase in 2024 and has been processing real commercial transactions. The platform enables a Thai importer to pay a Chinese exporter in yuan, with the transactions settling in minutes rather than days and at a fraction of the cost charged by traditional banking networks. The BRICS bloc has expanded dramatically in recent years. Brazil, Russia, India, China, and South Africa were joined by Iran, Egypt, Ethiopia, the United Arab Emirates in January 2024. Saudi Arabia has participated in BRICS activities, though its full membership status remains diplomatically ambiguous. Additional nations have applied for membership or expressed interest in joining. The expanded BRICS nations now represent approximately 45% of global population and a substantial share of world economic output. They control critical commodities, including oil, natural gas, iron ore, and agricultural products. Their combined economic weight gives them leverage to negotiate alternatives to dollar-based trade. These nations share a common interest in reducing dependence on a currency that can be weaponized against them. The freezing of Russian reserves demonstrated that dollar holdings exist at the pleasure of Washington. Every central banker in the developing world took note and began reconsidering their own exposure. The system being constructed is not yet ready to replace the dollar, but it represents insurance against a future where dollar dependence becomes strategically untenable. The breaking point: every financial system has thresholds beyond which it cannot function normally. For the United States Treasury market, the critical variable is foreign demand for new debt issuance. The government must continuously sell new bonds to refinance maturing obligations and fund ongoing deficits. Now, when this process works smoothly, nobody pays attention. When it falters, the consequences cascade through every corner of the global economy. In fiscal year 2025, the Treasury needed to refinance approximately $9.2 trillion in maturing debt, while simultaneously funding a deficit approaching $2 trillion. This creates an enormous volume of securities that must find buyers at rates the government can afford to pay. Foreign central banks have historically provided reliable demand for this debt. They purchase treasuries to manage their own currency values and to park their trade surpluses in safe, liquid assets. But that demand is no longer growing. Major holders like China and Japan have been reducing their positions or holding steady rather than accumulating. The foreign share of Treasury holdings has fallen from nearly 50% a decade ago to roughly 30% today. The question becomes, who will buy the debt that foreign central banks no longer want? The Federal Reserve absorbed trillions during its quantitative easing programs, but has been reducing its holdings through quantitative tightening. Domestic banks face regulatory constraints on how much government debt they can hold. Pension funds and insurance companies have their own allocation limits. If buyers become scarce at current interest rates, rates must rise to attract new demand. But higher rates increase the government's borrowing costs, expanding the deficit and requiring even more debt issuance. This creates a feedback loop that can accelerate rapidly once it begins. Analysts have identified declining foreign participation as a key risk factor for market stability. Below critical demand levels, domestic buyers would need to absorb unprecedented volumes, likely requiring significantly higher yields that would strain the entire financial system. China's continued selling pushes the system closer to instability with each quarterly reduction. The margin for error grows thinner as the largest holders reduce their exposure and the refinancing calendar grows more demanding. The stages of collapse reserve currency transitions do not happen overnight. They unfold through identifiable stages that typically span years or even decades. Understanding these stages helps clarify where the United States currently stands and what warning signs to monitor. The first stage involves gradual diversification by foreign holders. Central banks begin reducing their allocations to the dominant currency while increasing holdings of alternatives. Gold purchases accelerate. Bilateral trade agreements denominated in other currencies multiply. This stage proceeds quietly, often dismissed as routine portfolio management rather than systemic change. The second stage features rising financing costs. As foreign demand weakens, the issuing nation must offer higher yields to attract buyers for new debt. Interest expenses consume growing portions of government revenue. The central bank faces pressure to purchase government securities directly, effectively monetizing deficits. Inflation becomes harder to control. The third stage brings acute market stress. A triggering event exposes the underlying fragility. It might be a failed treasury auction, a geopolitical crisis, or a sudden large-scale sell-off by a major holder. Yields spike dramatically. The currency experiences rapid depreciation. Capital flight accelerates as domestic and foreign investors seek safety elsewhere. The fourth stage is systemic restructuring. The old monetary arrangements become untenable. New frameworks emerge, often featuring multiple reserve currencies, commodity backing, or regional payment systems. The transition imposes severe costs on the declining power while creating opportunities for rising alternatives. The United States currently exhibits clear symptoms of the first stage and early indicators of the second. Foreign central banks are diversifying. Gold accumulation has reached generational highs. Alternative payment systems are becoming operational. Interest costs have begun consuming unprecedented shares of federal revenue. The timeline from first stage to fourth stage varies considerably. Britain's collapse in 1931 compressed the process into weeks. The dollar's displacement of sterling as primary reserve currency took decades. Current conditions suggest something between these extremes. The September 21 Saint moment. On September 21, 1931, Britain announced it would suspend gold convertibility of the pound sterling. The decision came just 8 weeks after France began systematically testing British reserves by demanding gold for its sterling holdings. What had seemed impossible in July had become inevitable by September. The speed of the collapse shocked observers worldwide. Britain had been the center of global finance for 2 centuries. The pound had been the currency against which all others were measured. British bankers had financed the Industrial Revolution, the Railway Age, and the expansion of global trade. None of that history provided protection once confidence evaporated. The mechanics of the collapse followed a pattern that repeats across monetary history. Creditors, who had accepted assurances of stability, began to doubt. Their doubts prompted withdrawals. Withdrawals depleted reserves. Depleted reserves undermined confidence further. Each stage accelerated the next until the entire structure gave way. China's systematic reduction of treasury holdings represents a modern version of the same examination France conducted in 1931. Each quarterly reduction asks the same implicit question: can America actually honor its obligations if enough creditors demand payment simultaneously? The honest answer is that no one knows. The Federal Reserve could purchase unlimited quantities of government debt, but only at the cost of currency debasement that would devastate the dollar's purchasing power. The Treasury could prioritize foreign creditors, but only by defaulting on domestic obligations. There is no costless exit from a debt trap of this magnitude. What China appears to understand is that the question itself creates instability, regardless of the answer. Simply by reducing exposure and encouraging others to consider the same calculation, they increase pressure on a system already stretched to its limits. The September 21st moment for the dollar will not be announced in advance. It will arrive when accumulated pressures finally exceed the system's capacity to absorb them. The only certainty is that those who prepared in advance will fare better than those who assumed the impossible could never happen.